Hi, my name's Joe Wright, and today I'm here to discuss Seven Group, a diversified investments and operating group with key holdings across the industrials, mining, energy, and media sectors. Some of the key businesses in Seven Group include WesTrac, an authorised Caterpillar dealer, Boral, an Australian construction materials business, and Coates, a national equipment rental provider. Seven Group also has investments in unlisted and listed energy assets, as well as the shareholding in Seven West Media. We think the market discounts the quality of Seven Group because of the sectors that some of the key holdings sit in, and also because it's a conglomerate. Conglomerates tend to have a poor reputation for detracting from the returns of the underlying businesses through a bloated corporate structure. But in our view, the corporate structure of Seven Group is relatively lean, and management has a strong track record of capital allocation and improving the returns of the underlying businesses. WesTrac is the authorised dealer of Caterpillar yellow gear in WA, New South Wales and the ACT. Effectively, WesTrac generates sales and earnings in two ways. One, they sell new vehicles, and two, they sell product support, which includes the sale of parts and maintenance services. More or less, a customer uses WesTrac to buy a new piece of Caterpillar gear and then service that gear for the rest of its life. As a customer's fleet ages and grows in size, naturally their demand for parts and services increases. If you have a look at the chart on the screen, sales from product support in WesTrac have actually grown pretty steadily over the last decade, even as commodity prices have fluctuated over the same period. Most mining services companies generate their revenue and earnings in lumpy contracts that are competitively bid and for which the returns on capital are actually pretty low. WesTrac, on the other hand, now generates majority of its revenue and earnings from maintaining their customers' Caterpillar fleets, which is effectively a recurring non-discretionary spend for those customers to maintain productivity. More importantly, WesTrac basically has a monopoly over this spend. In our view, the shift in sales of earnings of WesTrac towards product support over new vehicle sales has greatly improved the quality of the business. Not only are earnings more stable, but the through-the-cycle earnings base is now higher given the larger installed fleet, even as new vehicle sales continue to oscillate. It's that earning visibility, as well as the strong return on capital afforded to WesTrac by their privileged competitive position, that makes it the standout business in the mining services sector for us. Coates is an equipment hire provider that owns Australia's largest fleet of rental equipment and boasts a 20% market share. The company provides a range of rental equipment to customers for use in end markets such as infrastructure, mining and residential construction projects. Generally, equipment hire businesses aren't thought of for particularly high quality. The barriers to entry are pretty low and they're quite capital intensive, which means the returns can actually be pretty mediocre. We think Coates is the exception for a few reasons. One, the company has scale and a trusted national brand. Two, operating metrics like asset utilisation and earnings margins are top quartile versus domestic and global peers. And three, management has a really strong record of driving earnings growth and market share gains without doing acquisitions. If you have a look at the chart on the screen, from 2015 to 2021, Coates effectively doubled earnings from 100 mil to over 200 mil on relatively flat sales growth. Looking forward, the pipeline of infrastructure projects is actually really healthy, which should see Coates grow revenue at a faster clip over the next 5 years versus the previous. On top of that, management focuses the business internally towards the Team 25 goals, 25% EBIT margins on 1.25 billion of revenue by 2025. If management were to hit these targets, that would imply over 300 million of earnings by 2025. For us, it's the market-leading position of Coates, combined with a strong track record of management, as well as a pretty positive earnings outlook that makes the business attractive to us. Boral is a national integrated construction materials and building products business. It's a business that has existed in Australia for over 75 years and is basically synonymous with Australian construction. The past decade has actually been pretty disappointing for Boral. Returns fell away for a couple of reasons. One, the market position of the Australian business weakened as imports took share. And two, management went overpaid for some acquisitions in North America. Seven has long flagged the Australian construction materials business as one of interest for the right price. And to their credit, they were effectively able to build a position on market, entering the stock during the 2020 downturn without paying a takeover premium. They were then able to flip the North American assets at a pretty fair price to pay off the transaction debt. Now, with the 70% shareholding in Boral, we see the opportunity for Seven Group as twofold. Firstly, if Boral can reset its cost base and start pushing price now that the competitiveness of imports has actually weakened, earnings margins should be able to lift in line with peers and returns should start to better reflect the quality of the asset base. If we have a look at the chart, while revenue is cyclical, it's really been the margin that's deteriorated for Boral. And so any resetting of the cost base should actually be able to drive earnings leverage to the upside pretty quickly. Secondly, Boral has an extensive portfolio of surplus property that's basically been used to plug earnings holes for the last 15 years. We think there's a real long-term opportunity there to create value by developing non-core holdings and rationalising the existing operating sites. In our opinion, the recent earnings downgrades of Boral are more one-off than structural in nature and don't distract from the long-term turnaround opportunity. At Airlie, we think a turnaround opportunity needs three things. One, proven management team. Two, good assets. And three, balance sheet optionality, all of which Boral now has. WesTrac, Coates and Boral form the lion's share of our Seven Group valuation. Each in isolation has a quality that we look for in our early investment process, whether it's the privileged competitive position of WesTrac, the strong management team at Coates, or the asset base and turnaround opportunity of Boral. Overlay Seven Group's impressive management track record and evaluation below market multiples, and we think the stock looks incredibly compelling.